Hey, this is Jake Taylor, your host of the world's first interview Hikecast. We dive deep as interesting people take me on their favorite hikes. So if you're ready for something a little different, throw this on, get outside, and come take a hike with us. Today we're going for a hike with Dan Sheehan. Dan is a general partner of Sheehan Associates Limited Partnership. He started his investment partnership in 1999 and has put up unbelievable numbers since then. We went for a chilly walk around Toronto, Canada. Please enjoy this Hikecast with Dan Sheehan. But first, please save a spot on your shelf for my new book that's available now. It's called The Rebel Allocator, and it's a fictional coming-of-age story about a young man who learns about business and life from an unlikely teacher. Imagine Thorndike's The Outsiders meets The Karate Kid. You're probably saying to yourself, fiction? Really, Jake? My goal was to give you everything you'd learn from a good nonfiction book, but wrap it in an entertaining story. It's available now on Amazon in both print and digital formats. And now, without further delay, let's get outside. Yeah, I thought maybe we'd start with, I'd like to know more about your background growing up, and where you grew up, what your parents did, like all those kind of things. What did you want to be when you grew up?
I didn't really have any particular thing I wanted to do. I was a pretty bad student actually, from maybe grade 6 until I went to university. I got kicked out of university. I had to and I got back in, and it was like, I went to college actually. There's a sort of difference between university and college in Canada. And I went to college to get back into university, and for some reason that turned things around. But
Was it just grades that you didn't, or was...
I don't know what it was. I just didn't care about it, and then I did care about it, and I can't explain what happened. But then once I did care about it, I was like, how I could ever have not cared about it, I don't know. I just had to grow up, I guess.
Yeah.
But I grew up in Port Credit, which is not where I'm living now. My wife and I moved back there about 3 years ago, which is a suburb of, it's a small part of Mississauga. It's not far from Toronto. My mom was a nurse. My dad was a geologist. And
did he travel a lot?
Yeah, he traveled a lot. We were at the airport when we were kids. We were at the airport. My sister and I were kids. We were at the airport, it seemed like every other weekend, waiting for him to...
Wait for Dad to come home?
Yeah.
Where did he go?
Mainly Northern Ontario, but Australia, all over the place. So he eventually ran the exploration department at a fairly big mining company in Canada called Lac Minerals. And he passed away in 92. And after that, I sort of realized that his approach to exploration was really kind of the same thing you use in value investing.
Is that right?
He didn't have a degree in geology. He went to, I think, university for a year, and was like, I'm done with it, went back to work. So he just kind of worked his way up. But
practical education.
Yeah. But one thing that's interesting is outside of his working life, he didn't apply the same concepts.
Domain kind of blindness.
Yeah, he was buying penny stocks all the time. We had a change room at our house that was wallpapered with stock certificates that had gone to zero.
Really?
Yeah. So I joke he's celebrating his failures. Yeah. But
the wall of shame.
And was, him and a buddy were at the track on the weekends.
Oh, really? So he had a little gambler in him.
Oh, yeah, no question. And so that's kind of how I got into stocks, learning about stocks and stuff, but I had no direction. And then, like so many people, stumbled across Buffett.
Were you in college? Was that in business school?
I was in business school. And I'd like to say, the light bulb went off like that, but the kindling was a little too wet. Took a while.
Yeah.
Because I actually started another business with a friend from university.
Is that the gym part?
No,
okay.
no. This
That's
was
later.
a secondary aluminum smelter.
Oh.
Don't ask. If I had figured out investing 6 months earlier, I don't think I would have started the business because I would have known not to do it.
Right.
Anyway, so I did that for about 3.5 years. It was not going great. Eventually got a chance to sell it and I got out. And during that time, I'd started sort of learning about and applying value investing just to my own, with some money I had. And it sort of became obvious to me that I should be doing something along those lines.
Yeah.
I knew nobody in the industry.
When did it click for you that like that's something that you could do for a profession?
It would have been around that time, 96, 97, something like that. One of the things was I was in that first business I started, we were busting our hump on it and not making any money.
Yeah.
And what little time outside of it I had, I was doing the best I could investing, and I was making way more.
Yeah.
And it was
the opportunity.
Yeah. So it was kind of a no-brainer once I got out of the other one. Not knowing anyone in the industry or anything, it ended up being a blessing, right? Because one, you can think completely independently.
Yeah.
And I just said, I'll just start a little partnership with family and friends. And
was the partnership that was just like you saw what Buffett started and
yeah,
said like,
just
hey, copy that and just see what happens.
Exactly. The whole performance only, cumulative hurdle, all that stuff just all made so much sense that it was. And I was in the opportunity cost. I wasn't married. I didn't have kids at the time or anything. It was easy to start it. I ran it out of the house. I'd go to the library to read Value Line. It was just
low overhead. It was like a simple operation.
Yep.
Life was very tidy, probably.
Yeah, and also that period of time, it was obvious that people were delusional about the bubble that was going on.
Yeah.
So if you just help people avoid that, you were going to be of service. You didn't even necessarily have to find great investment. Yeah. But it was also, we started in September of '99, and I think by April, May of 2000, tobacco stocks got super cheap. That was sort of my first really big investment. And it was, in some ways, the easiest time since I've been in the business.
Yeah.
Because there was stuff that was, absolutely cheap in my view. But in relative terms, it was
insanely cheap.
Insanely cheap.
Yeah.
I haven't seen.
It's one of those rare setups where it seemed obvious that you had a good chance of making money, even with the market going down. But
yeah.
Which is like that's how you make a legend of yourself, right? Is put up big numbers when the market's going down.
Yeah. And so I got lucky, started at the right time. It's even when I kind of stumbled onto Buffett was, a time of my life where I was ready to accept it. As that saying, the teacher doesn't
shows up when the student's willing.
Yeah. Because I would say most of my life up until then, if someone like my dad had tried to teach me that stuff, I'd probably, you don't know what you're talking about.
Do you think that it's kind of interesting counter history to run, but what if you had started your partnership in '95 and you had to endure those 4 or 5 years where value investors were just basically you don't know what you're talking about. You're Buffett. You're washed up. How do you think? You think that? How do you think you would have handled that?
I did pretty. I did well from '95. I probably had my best results from '95 to '99, just with my own money. Now, as soon as it's other people's money, you'd like to not think you don't change your behavior. I don't know.
Yeah. It's harder though.
It's harder, and we've talked about this a bit. I don't know if what I did from '95 to '99 I would do now, knowing what I know. I don't know how much of it was also, I was getting a tailwind that I didn't deserve necessarily.
Yeah.
So I don't really know the answer to that. That was a period of time that kind of gave me some confidence that I could do it.
Yeah. How far into that did you feel like where you no longer had sort of imposter syndrome, or? Because like not having any real industry experience and coming in, like there's had to have been at least a time where you're like, boy, do I know what I'm doing with other people's money? This is kind of scary.
I didn't. I don't know. Maybe this is. I never really. I always felt like I was doing it with my own money too. Every decision I was making, I felt I could explain.
Yeah.
So even if it didn't work out, I thought I'd be able to explain why it didn't. And I never. I mean, I should say never had those feelings, but really that hasn't been a big factor in what I've been doing. I don't know. I mean, I think the biggest struggle has been the last 4 or 5 years, and trying to figure out now if in this environment I can still add value.
Yeah.
And I think I'm way better now than I was back then, but
ironically, like way more deserving, but then
yeah, I mean, you gotta deal with the world as it is, right? And sometimes it's a tougher nut to crack.
What do you think is that's making it harder today? It's kind of everybody has their pet theories, but
probably the closest thing to the truth is Mubassan's idea about that. It's just become way more competitive. There's the paradox of skill, right? Skill level increases, and then you can't differentiate yourself as much as you used to.
Yeah, it flattens out the performance of everyone.
And so judging yourself based on past history might not be a good way of, you can't hold yourself to that standard. Now, maybe that's just an excuse too, I mean, am I as hungry now as I was like back then? No. I was really driven when I was with the start of the partnership.
Yeah.
I'd like to think I'm wiser now.
Yeah.
But
you're working smarter, not harder.
Yeah.
Hopefully.
Yeah. But who knows? That's kind of for other people to judge. But yeah, definitely. I think there was easier times in this business than now. I think. And I think that eventually changes, but how and when.
Yeah, and how long it takes
and why
is.
Yeah.
How much pain do you want to endure to get there?
Yeah.
It's definitely a question mark for a lot of us.
I mean, in an economy that's growing by 2 or 3% at most, real terms, to expect that you can
get 10%.
Yeah, have like
as a birthright.
Yeah, it's kind of ludicrous, right?
Yeah. Theoretically, you shouldn't be able to earn a whole lot over whatever the country's producing, right?
Yeah, any piece of that you get that's greater is, pretty good, I think.
Yeah, and really only comes from basically like multiple expansion, like everyone just being a little bit more willing to pay up for that same 3%.
And yeah, one big difference too, well, this is sort of along the same lines, but yeah, when I started in the industry, there didn't seem to be, it almost seemed out of favor.
Yeah, I've thought about that one a lot actually. Like I came to value investing more 2006, 7-ish, 8, and it had a fantastic run. Mm-hmm. And I almost think that I was like a momentum value investor. Like I got to it when it was hot and got sucked in. And I should have expected it to like have a bad stretch after that if I was really logical and understood more of the puzzle. I didn't know anything about that when I got into it.
Yeah,
I bought value investing high.
From what I know about you, I don't think it was that was bringing you into it. I think the same things that brought me into it is the the logic and thoughtfulness of Buffett and Munger.
Yeah.
Which I think it is applied for the last 50 years.
Yeah, no, it's true. But the fact that it came up on my radar, just naturally it's going to be more visible when it's doing well.
Yeah, but yeah, it's funny. There was that sort of lull in the late 90s, mid to late 90s, but since then, even though now they talk about value's been not working and all that, I don't know if that's true, but
yeah, that's an interesting question.
There hasn't been an abandonment of it like there was in the past.
Yeah. What do you think has happened? Like, why have some of the better, bigger known names really struggled over the last couple of years, especially? But yet other kind of flavors maybe of value haven't as much. I mean, they've maybe underperformed, but they're not losing money. But some of them have been losing money.
Yeah, I've been trying to figure that out because I don't want it to happen to me.
Yeah.
And the fact that I don't think I have good answers necessarily is kind of scary.
Yeah.
Because, then think it could happen to you. I don't know, some of it's maybe some of the people that got the attention, in some cases, wasn't quite deserved.
Yeah.
In others, just complacency, I guess. Or just sometimes a string of good luck, then a string of bad luck. It's hard to know.
Luck is really underappreciated, I think.
Oh, huge. Yeah. I've made over 20 years 7 or 8 decisions that have carried. I haven't figured it out exactly, but I would say 85%, 90% of the returns.
Yeah.
The rest of the stuff is just
at the
finding
margin
something to do.
Yeah.
And
justifying your existence.
Yeah, and just have 1 or 2 of those 7 or 8 go the other way somehow.
Yeah.
And that really changes.
Yeah, it gets dramatic.
Yeah, and I'd like to think that all those 7 or 8 decisions were pretty good decisions, but even if they were, that doesn't mean the outcome was necessarily going to work out. And plus, I'm sure everyone thinks they're not the one that got lucky.
Oh yeah, of course, no.
But
that was skill.
Yeah, I try to be fair in assessing that, but
yeah, we're all the exception, right?
Yeah. I do actually. One of the things that this might get to why some of the people it's really become a whole industry. All the conferences and presentations and all this kind of stuff, and you don't even notice groupthink could be, coming into your behavior. And
oh yeah,
I worry about that because for at least 12 years I did this. I was basically in
a blog.
Knew no one.
Yeah.
Didn't talk to anyone in the industry. I think that let me see things just slightly different than maybe some other people, and that could be all the difference.
Yeah. Yeah, no, you think about some of these, I don't know, Valiant comes to mind. A lot of people you think would be, they get sucked into it.
Valiant was such a strange one. I mean, some people got sucked in, or maybe not that big a surprise, but then others, like you said, how'd they end up there? Because to me, it was especially when I was running, I couldn't get it. Even if I assumed their numbers were real,
yeah,
I didn't think it was worth more than the debt they had outstanding.
Right.
So no equity value. And
yeah, it's very interesting. It was almost like everyone thought the other person was doing the due diligence or something. Well, if this guy does deep research, and if he's in on it, then it must make sense, right? And then you go and look at it with that frame of reference, and every data point that might have gone either way, you give it the benefit of the doubt. Which
Yeah.
is a dangerous thing that can happen if you stack too many of those up.
Yeah, I mean, it's like so many things, right? There's these, like this idea of cloning and
Yeah.
paying attention to what other good people are doing. I mean, me paying attention to what Buffett did for 50 years is what led to me being able to get in, do anything. So in some ways, I'm doing that, but then also I think the danger with that is, like you said, it kind of lowers the bar somehow.
Yeah.
When you look at stuff.
Yeah, your criticality of it gets reduced.
I mean, in some ways, Valiant kind of felt like it was people were, it was getting hard to find good opportunities, and people are afraid of missing out. I don't know exactly, but
Well, it seemed like you had this outsider CEO, kind of a compounder story, M&A, and
yeah,
it seems like maybe they will make more money in the future potentially from all that.
yeah, it's interesting because that was not long after Outsider, that book came out. Right?
Yeah.
Everyone's
primed.
Yeah, and I know they're hard to find. I think they're super hard to identify
pre-success.
Still after the fact.
Yeah.
And then
you always end up having to pay up at that point.
Yeah, and just because they're doing things differently doesn't mean
That's right.
they're they qualify as a great capital allocator.
Yeah. How do you assess capital allocation and management?
Well, I would say some vast majority of the time I just assume bad capital allocation. I would say, I've hardly ever bought companies based on outside, they're going to grow at tremendous rates. I just don't think I want that for free.
Right.
Because it implies change in my, it's hard to get. I'm looking for like inertia, like where basically people think things are going to change, and I think the chances of change are way less than they think.
Yeah.
And
you're betting the status quo is lasting
Yeah.
longer than everyone else.
yeah, I'm trying to look for situations where I think for one reason or another they're not going to do stupid things.
Right.
And hopefully more often they're actually repurchasing shares, but I can't say that. Normally, we've owned some stuff and it might have stayed cheap for a while, and they were repurchasing shares, a lot of shares, and so you could say that was good capital allocation. But what happens generally is when the stock goes back to fairly valued or overvalued, and usually I'd be out by that time, at least my opinion of it, they continue to buy back shares at the same rate.
Yeah.
At least in terms of dollars.
Right.
So it's not because, I just try to get situations where I think they can maybe do the right thing, not because they know to do the right thing, but because the stock's cheap or something.
Right. So like any lever that they'd pull would maybe be the better lever for you, but not expecting them to like maneuver it.
Yeah.
And
Yeah, CEOs turn over too quickly in most cases to really judge them. There's always exceptions to the rule, but I think if you're going to try to hold the opportunity set to CEOs that you're really impressed by their capital allocation, your pool gets so small.
yeah. Do you think, so would it be fair to say that you are much more interested in the underlying business itself than the person who's navigating the business?
Yes, very much so.
It's the ham sandwich rule, maybe.
Yeah, and the things that I've done that haven't worked out that well have been because it wasn't a great business. Same situations in some ways that maybe, or similar situations that I thought created an opportunity to buy in at a decent price, but the ones that worked out are because the underlying business was better.
Do you ever, one of the things that kind of makes me nervous about that strategy, which I totally agree with, is if we actually do get more acceleration of change from technology, and like moats just don't last as long as they probably once did. So it gets harder. You have less time for a good business to be a good business and earn the ROE that you need to actually turn into a dramatic kind of investment return. What do you think about that? Or is that everyone always thinking that the future is going to change faster than it really does?
Yeah, I don't know. I mean, in some ways I think it's quicker. In other ways I don't. I think getting too caught up in trying to figure that out, you lose sight of when you do stumble across something that makes a lot of sense. I mean, up until recently, every couple of years you could find something that you didn't. They're cheap enough and a good enough business that you didn't
have to worry too much about obsolescence.
Yeah. I mean, that's the whole game, right? Figure out the ones that are less subject to that. That's always how. I mean, if you look at all the consumer food companies, like beverage companies, so many of them, when I got into the business, if you looked from, you just looked at the value line charts on all these things, they just had all killed it for the 15 years they show on Value Line.
Yeah.
And that period, from then till now, is very different.
Yeah, look at just Coke as sort of a bellwether.
Coke hasn't, none of them have done, and I'm not talking about the stock price, picking a period like Coke when it was 50 times or something. I'm talking the underlying operations.
Yeah.
It's just been a different world. Now that earlier period had some of that was inflation built into those numbers. So the real numbers in that period would have been lower than they look at first. But even accounting for that, it's night and day.
Yeah.
And it doesn't seem anyway that that's gonna, if anything, that it might be, the next 15 years might be tougher for them than the last 15.
Yeah.
To me, all that, Graham stuff, all Buffett stuff, it's not about cookie cuttering these things. It's about kind of learning the thinking and then applying them to the situation at the time and trying to figure it out. But
right, everyone wants a formula.
Yeah, they all want a formula, but
teach you more how to think.
Yeah,
more of a philosophy.
Yeah, I always tell people there's a bunch of things I've done that 6 months before I did them, or even less than that, I never imagined I'd do them. Right? They're just something you stumble across. You're always looking for wide variances between value and price, and occasionally if you find those, you can make a decision, you can do something that can take advantage of it. But who knows where it's going to be, how it's going to present, when.
Well, I think that's really the amazing thing about watching Buffett and Munger over the last, this time period, and having, it's all public, like every decision they make basically. And you see, like take airlines for instance. I mean, these guys bagged on airlines for 3 decades, and then something changed, and they got past that, like all of the previous sunk cost and thought and, railing on it, and then they bought them, and they bought a lot. I mean, they're 10% holder, and I think all 4 of them, pretty much as they can get into them.
Yeah,
it's a testament to their mental flexibility
and things didn't just change for the airlines; they changed for them. If they were, if it was 40 years ago and they're managing the amount they were managing then, I don't think they're investing in the airlines. Right? It's
right
where they can get some capital deployed,
right,
and get a reasonable rate. And they're also, my guess is, this is just a guess, but it would not be something they would put 25% of their net worth into. It's
still airline.
It's a much smaller bet than, and then it's also a bunch of the airlines. They're not picking and picking 1 or 2. So it's not like the investment they made in Coke when they put a quarter of their equity into it.
Yeah.
So sometimes I think people we maybe hold them to a higher standard with some of the decisions they make or something. That you got to judge it based on the entire.
Yeah, what was available, where were they? I think about that too, about like, where they are in their career. Like, they obviously don't have, they don't have 30 years probably left, right? So when you get to the finish line, maybe you behave a little bit differently. I wonder about that with Buffett and his he's a little bit more guarded, I would say, in some of his answers, just politically. And I think he's just like, I'm at the kind of towards the finish line. There's no reason to ruffle feathers. It's just what it is.
Yeah, I don't know. It could be that. It could also just be, if you're reading Outstanding Investors Digest from the mid-90s or something, it wasn't being, although we now know it was going to eventually be televised. But I don't think, now it's like live streaming and stuff. And so I think,
just a little more careful.
Yeah, I would think that, even more careful about criticizing by category.
Yeah, true. It's a more public world too. I mean, everything you say can turn into a soundbite.
And we all tend to, I think we generally mellow somewhat with age.
Yeah, hopefully.
I think I was pretty hard ass when I got into this and more critical. I mean, I don't know. It's sort of, you
probably come to appreciate the subtleties of life a little bit more as you get older and realize that things aren't as black and white as they seemed. And
yeah, I think so.
Let me ask you this. I know that there's been a lot of charts out lately that show growth versus value, and this big rubber band stretched between them especially the last 5 years, let's say. And so a lot of people are like, man, this must be the time to get into value. And one of the things that I'm concerned about right now is that, yes, the discrepancy is big there, but on a absolute basis, I don't feel like I'm seeing a lot of things that are cheap on a kind of historical relation to other time periods where I could get businesses and assets for much cheaper. So, and any time I'm buying for more, I feel like I have a lower expected return. So maybe the value, even though it's cheaper than growth, but it's not like super cheaper on a historical basis, which makes me a little less hesitant to want to really push hard on all my chips into the pot for a value bet. What do you think about that?
Yeah, I mean, I don't see everything looks, I mean, with the caveat about interest rates. If interest rates are permanently low, like going forward, which I think is a dangerous assumption to make, but if you assume that, then yes, stocks are pretty attractive, but I don't see this big bifurcation between whatever, these kind of arbitrary categories of value versus growth. I mean,
it doesn't feel like 99 to you?
No, nothing like that.
Yeah.
Now, I think it's harder. Then it was obvious. I mean, there was companies that were obviously worth zero, selling for tens of billions of dollars. And you couldn't even kind of wrap your mind around it being a business model that worked or anything.
Right.
Now, there's a lot of businesses that I think work as a business model, but the valuation's a huge stretch, and so it's obvious. Obviously, right things, good opportunities, and obviously really bad opportunities, like I did back then.
Yeah.
To me, there was obvious things not to do and obvious things to do, and now
it's not the same.
I think there's some stuff that I wouldn't do. I don't think it's worth the rest of it. Might well work out for people who did it. Not necessarily. That's why I think it's that we happen to be in, at least for me, this tougher environment. Right now, I don't know. somewhat there's a lot more competition. Some of it's just the environment, like what the opportunity set. I don't know. Compare it to the past. I don't know how comparable it is, because you couldn't go from zero to like almost a world leader that you don't know who's second in the industry seemingly overnight.
Right, like an Uber,
Airbnb, Uber.
Just dramatic growth.
Yeah, it's incredible how quickly these have come on. It was just physically impossible to do that with most industries up until that infrastructure, that sort of framework of technology got laid that you could do it.
Right. Now that a lot of it is just software and like zero marginal cost kind of world, it's different. The businesses are different, the ability to make money, the returns on capital. That's one thing I struggle with is a lot of these companies are not making any money either. And yet, I don't know that they don't get to the scale where they actually do make a ton of money. And it's not obvious to me if the things that they're spending money on now and like subsidizing all this growth, really, like it's VC subsidized growth. Like every Uber trip you take is subsidized. When the economics actually get to where it has to be priced for sustainability, profit, does it still make sense? And does everybody still love it? And I don't know, like those are really hard questions. And they could totally be right, all these VCs who are making these bets, but I don't know. Like that's a really difficult game to play.
Yeah, it's incredible how, and it's gone on for so long. Like these companies can, go really decades without making money.
Yeah, which that feels like a new,
and are kind of going. We talked about this yesterday. The capital requirements are almost going backwards instead of becoming like all these companies basically, a lot of them ran with zero capital.
Yeah.
But some of them are now becoming much more capital intensive as they're all competing to sort of maintain their place in the world. And
yeah, whereas before it was always like you had to spend a ton of money, get the machinery, get the land, get whatever the tangible, but working capital that you needed to create your business.
Yeah, and this game of continuously having to stay on that treadmill and no capital ever comes out. If you eventually, it's sort of like almost all the home builders, in the U.S. leading up to 07, 08, doing great, but they're never taking any money off the table.
Yeah.
And 07, 08, like when you lose it all.
Yeah, I wonder about that with like Netflix. If you always have to spend $20 billion in content every year and growing, when do you? Yeah,
all the profits may just go to the consumers, because we get like the quality. You think of the quality of Game of Thrones versus old TV shows. It's high-end movie quality TV shows, production.
Hours and hours of it.
In theory, the technologies come along that they should be able to make stuff cheaper, but that's never what happens, right? They end up spending more.
Right. For us, the consumer, to win.
The consumer, and then I guess writers, actors, and all that. There's probably a lot more room. I would guess there's more actors getting paid more money these days. I don't know, but
I think so. That's my understanding, is that projects now get greenlit and they make a lot of money early.
Yeah, and I think it's too early to know the answer to this, but I wonder about this change in consumption of, say, stuff like video, like what Netflix is producing. They go from a serial show where you waited once a week for it and you would watch reruns, and so people might watch Magnum PI in the 80s. They might have watched each episode 3 or 4 times.
Right.
But shows that you binge, I don't know if you go back and watch them again.
Yeah, totally. And I
Like,
wonder about even the obsolescence of all this content. Like, who's going back to watch Lost right now if you've never seen it?
Yeah, probably not. I mean, there might be a little bit, but nothing like there used to be. There's basically...
It's disposable now.
Yeah, and so that treadmill is just sped up, and it keeps getting steeper because, like...
Disney's launching their own streaming, and like Amazon's overspending.
$250 million just for the rights to Lord of the Rings. I mean, it's incredible.
Yeah.
If you argue that launches something, I guess you could. But yeah, it's just, what's next? What's the next level? It's scary.
So the short answer is that it's hard right now.
Yeah.
Maybe Munger would say, if it's not hard, then I'm worried about you.
Yeah. Should it be such that there's just these low-hanging fruit all the time? Probably not.
True.
You don't need a lot of opportunities, and you don't need them to be like, you just buy something that's growing at 6 or 7% in terms of value, and if you get that at occasionally half of what it's worth and sell it at close to fair value, you don't need so much turnover, and your results are pretty amazing. So you don't need things that are growing crazy and all that stuff. I mean, if you happen to luck into something like that, fantastic. But
I think that's where been one of my downfalls, actually, more so, or shortcomings, I should say. No, maybe not downfall, but is that like I want to wait until it's so obvious cheap that I'm like, it's a no-brainer to me. And I worry that in this world now that either, a smart beta product is going to pick up on it before it gets down to my level, or even like I've heard some people say like that the Fed has kind of crowded out value investors because they intervene before prices can kind of come down to you and push it back up, back up towards, maybe call it fair value. And so you basically just get crowded out and you sit there with no ideas coming your way. And I feel that kind of like my experience feels that way. And that could be just a form of laziness or something and blaming the world for your troubles, but.
Yeah, I mean, it may essentially be doing that because, we have this standard rate sort of thing, whatever it is, you discount things in theory at 10% or something like that. So in today's interest rate world, if you use that standard, then yes, it looks like.
And then want to pay 50% of that, and it doesn't happen.
Still, you don't have to go back that far, and there were some opportunities and some pretty well-known names. Now, you could argue maybe it remains to be seen whether they really were good opportunities, but like Amex was, after they lost the Costco account, got down to, 10 times earnings. Now, some people might say, that fintech's changing so much and it should be at a low multiple and stuff, but, relative to Visa and MasterCard, that, it was really cheap.
Yeah.
And they're not exactly comparable businesses, but, and that wasn't that long ago. That was just a few years ago. So they've just been a little fewer, and maybe we also got a little spoiled with 08, 09.
Oh yeah.
Where everything was selling for crazy cheap prices, and
I mean, they call it a generational buying opportunity for a reason, right? It doesn't come along every 5 years for you to replenish your stock.
Yeah, and it could have been a lot worse, right? Like, I think some things worked then that I don't necessarily know were worth the bet.
Yeah.
A
lot of highly levered companies.
Yeah, it just didn't last long enough to bankrupt a lot of companies that otherwise, if it lasted 6 months longer or another year or two.
Been game over for them.
Yeah, it could have been game over for a lot of companies. And the fact that it wasn't, most of them probably were the best returners, over that time.
Oh yeah, I think about I don't know, did you look at rental car companies in 2008-9? Ton of debt, but the equity coming out of that just was like a rocket ship.
Yeah.
Like 10Xs all over the place.
Yeah. Yeah. I mean, a lot of that stuff I have no problem missing out on.
Yeah.
The one that bothers me the most is Lazy Boy.
Oh yeah.
It got down now they had some debt, and so there were some issues, right? And it's tied to housing, and if it didn't necessarily have to work out terrific, but I've not seen in 20 years any brand that's as well known as Lazy Boy. It's kind of, my wife hates them.
Yeah.
I love them. Guys tend to like it.
Yeah.
But it got down to 50 million, the market cap. So even my partnership was only like 25 million or so then. I could have bought
half
10%,
of it.
of the company. And that could have been that could have been my Berkshire vehicle,
Yeah.
And to have it be called Lazy Boy, there's no better.
It fits well.
Yeah, it fits perfect.
It's
right?
totally on brand.
Yeah, and instantly you go from it would have been, it was perfect. For one reason or another, I didn't do it.
How did it perform coming out?
The stock's up at least 20-fold.
Yeah.
Market cap's in the neighborhood of $1 billion, I think now.
Yeah.
Why
would you want 100 million in
who
returns
wants that?
in 10 years?
But also it could have done so much more too, right? Like in terms of it could have been mattered more in other ways.
Yeah.
That's one that I kicked myself over.
Yeah, you'd get to sit in a recliner all the time, basically.
You just can't.
It'd be branding.
Yeah, recliners for life. What's better than that?
Wife could never get mad about it.
Yeah. It's just supporting the business, hon.
Yep. I mean, that's a good way to live your life, really, like that kind of congruence.
Yeah, what I think the right approach is to think about investing. Like, the business isn't investment management. The business is your partnership. You just don't happen to be an operator.
Yeah.
And have the freedom to pick the industry you're in.
Right. And change it whenever you feel like it.
Yeah. And
we've talked before a little bit about like the idea that you can assemble your empire at a moment's notice at 9:30 a.m. Eastern time every day and tear it down at 9:31 if you wanted. Yeah. And then reassemble it 5 minutes later in your vision of the world at that point. It's pretty amazing, really, as a luxury that we have in this day and age.
Yeah. Although it can quickly turn into a
liability.
A liability if you get too
creative.
Moving around. Take advantage of the fact that you can trade stuff that quickly.
Yeah, like any tool, it's a powerful tool. It can be dangerous or it can be incredible.
Yeah, it's actually, I don't think I'm very good at, I think I'm a decent buyer. I don't know that I'm a good seller or reallocator once I've committed to something.
Yeah.
I if it gets cheaper and stuff, I have no problem adding to it if it makes sense to add to it, but
you don't think you fully extract at the back end?
Yeah, I've seen some other people. I haven't really seen evidence necessarily of it, but I've heard people talk about that they are really strict about how they sell the things that they own, that not sell it completely. I'm just talking about reproportion things.
Right, rebalancing.
And I don't really have a good answer. I mean, obviously we all do that to some degree, right? But
yeah,
whether you're sort of systematic about it, and I don't know if I should be more at that, do that better, but it hasn't suited me to try to be that way. I think I would get too caught up in trying to fine-tune things, and
I wonder too about
take my eye off the ball.
You end up trimming a lot of your winners, and sometimes letting them run unreasonably long is maybe where a fair chunk of the alpha comes from. Letting it happen and not trying to intervene too much.
If you start thinking about that, like what you do on the selling side too much, then maybe it makes you somehow a little weaker on your initial purchase criteria or something. I don't know.
Yeah.
Like
if you have the mind that you can always dump it right away.
Or trim it if I think that just, you really need to have that attitude that you can't get out, when you get in. And then
that's been one of the arguments of why private equity has kind of performed better, is because they're locked up and there's no quoted price every day. And so you just sit in it, and that alone, just like kind of taking the human element out of it, ends up adding something to the process. I could believe that.
Yeah, I think there might be some. I mean, it's always hard to know because so many of the numbers you see about that stuff are not unleveraged.
To whatever.
Yeah. It's an IRR or something. It's.
Yeah.
I don't know if they're honest returns, and there's survival bias, and who in the private equity firms you're looking at. If you compare them to say so. I guess there's survival bias in an index too, but.
Yeah, but they had a fund that blew up, and that's not counted in the record. Speaking of PE, your partnership did something that was a little bit different than I think what a lot of sort of value guys who stick mostly to the public markets. You bought a private business in it. Tell me that story.
Well, it started by, it seems strange now to think back of it, but in, 2001 or 2, I'd written to my partners and said, I'm kind of having a hard time finding stuff. We're only 2 years old, and now that seems like, a wink time-wise, like it was just so quickly. But and I said, so I'm going to start looking outside of just public securities, and it was luck in a lot of ways. I had a friend who had started, him and another guy had bought a gym that wasn't doing that well.
Are gyms good businesses in general?
I would say back then most weren't.
Yeah.
And most followed sort of a cookie cutter approach. If you got one working, then they just open another one, and there's not really much difference between the gyms. And so what they did, and the other thing is most gyms are, like it's not just gyms, most places in life, when they open, they're never better. Everything's new and all that, and then with time, it's not as nice as it used to be.
Right.
And their approach was always, basically every year they wanted the place to be better than it was the year before.
Yeah, that sounds expensive.
To start, yes, but it snowballs, right? Like, I would say a lot of gyms aren't that much above break even, but the marginal cost of adding members is zero. So if you get above there, you can look pretty profitable. But
yeah, there's a lot of operational leverage.
Yes, yeah, you lose 10% of your members, you're out of business, right? Yeah. Over a few years, they got to the point they were well above that. Right fit, right time. It was before private equity had started buying gyms. I just did the Bubba model. All I had any say in was capital allocation above a certain amount, which was basically whatever,
Well, they would just come and ask for a check for like, hey, we want to put in.
It really didn't come to that because there was never an issue. They just did what they thought made sense, right?
Man, you're already decentralized.
Yeah, and we did move locations, not far, just to get bigger. So when we bought it, it was maybe 16,000, 18,000 square feet. By the end, we're 44,000. I don't know for sure, but I think we might have been the single biggest location in Canada.
Really? Huh.
Our whole thing was just every year get better at that location and not try to go out and think we could necessarily recreate that model.
Right.
Like it was in Brampton, which is a city not far from Toronto, and we ended up with a good location with cheap rent. So there was we had a lot of things work out well. The guys who were running it were great. I mean, when they started, they basically did something really smart. It just looked through the entire industry in North America and basically found the best operators, and then called them and said, "Can we come and visit with you?" And
nice. It's kind of how 3G did it. Like, I'm going to go visit Walmart, and then
adapted what they thought worked and what they didn't think worked. And
what kind of returns were there on like incremental capital?
50.
Really? Wow.
Yeah, our returns on capital were really high. We and then in 2007, like the private equity boom was going on. It was incredible. It was going on, like they were coming up to Canada. Like we sold to LA Fitness. Part because we were looking at companies like LA Fitness and Lifetime. They were building these like $30 million gyms that were, their returns on capital were like 8 maybe, and they pre-tax, and we're happy to have that. It was like almost just a real estate play.
Right. Yeah, now you're looking at like regular cap rates.
Yeah, they come and open up next door, and we think we could, I thought we would probably still run a better gym than them, but that doesn't mean it's going to be as profitable.
So the competition showed up.
One of the guys who was operating there wanted to sell, and that was the decision, yeah.
How'd you do the accounting for it in the partnership?
Not necessarily the way you should.
Non-GAAP.
Yeah, non-GAAP. I basically valued it because we were having people come and, still having people mainly come into the partnership. I wanted to be fair to the existing partners,
right, exactly,
and the exiting partners. So I just put a multiple of pre-tax income on it.
Okay.
And then I very much don't like disclosing. Like I did talk about, obviously I disclosed that we bought the gym, and I would talk about it a lot to the partners and write about it, but I don't like disclosing what we own. And so basically I just throw everything into investments. And I didn't want to fully disclose the multiple either, because I didn't want to give potential firms I might later be trying to buy.
Right. You don't want to give them a benchmark.
Yeah, I don't want to necessarily tell them. I just tried to do what I thought was the fairest all around.
Did you say you just did like 10 times EBIT or something?
It was lower than that.
Okay.
But I was conservative.
And you got to decide what it was, not like a kind of third-party assessment or anything?
Nope.
Yeah.
Wait, I didn't use that. I didn't use a lawyer to buy it. It was a handshake, and no traditional due diligence. I just judge.
Man, you really are Buffett, buying Rose Blumpkins.
Yeah, I mean, I just to me that all makes a lot of sense. I mean, I'm buying stocks all the time without doing some, obviously
without a handshake.
Yeah, and I think it makes you make sure the people you're doing deals with are, as much as you can know, honorable people, and that they trust you and you trust them. And
do you want to do that again?
Yeah, I'd love to. I mean, I'm trying to figure out. I've been telling my partners to varying degrees for 5 years. We kind of always had this, or at least I had a general rule that if someone was coming in, I'd tell them, you're not committed for 5 years, but if you're not thinking when you come in that you're at least committed for 5 years, it's not a good fit. And so about 4 years ago, I had started to think that I might transition to something else than just running the partnership. I didn't know what. And so I thought, well, I should tell them. So I just said, all right, 2020 is 5 years from now, kind of, giving people a warning that I might make a change. And I haven't completely decided what that change is.
Well, you've only got 6 or 8 months.
Well, it's not a hard line, but it'll be. I'm going to be doing something like this. But one of the things is I really enjoyed being involved with the private business.
Yeah. Did you help with like any kind of business stuff also? Like you have to have some insights from just studying business that would be helpful.
Especially one guy, Craig, who was one of the owner-operators. We're best friends. We talk all the time. So, yes, but I would have been doing the same thing whether I was involved or not, right? We still are. He's down as a general partner. He's basically backup for the partnership if I get hit by a bus. Not to run it, but to wind it down and help with the transition. And if we find some private businesses, he'll probably be more the lead and sort of keeping track of.
Would you want to put him in as an operator potentially?
originally my idea would always be find ones that we don't have to do that. If we have to do that, something's gone wrong. I've loosened a little bit on what I might be willing to do, that I might be thinking about finding businesses that are struggling a bit and go in and try to improve them. I mean, up until a couple of years ago, I would have thought, no, I'm not going to do that.
Yeah.
That I don't have any experience doing it.
Sweat equity starts to look kind of good right now when returns are so low. Right?
Yeah, it's just maybe you gotta try to figure out how to adapt to the world and do something. But in doing that, I might be willing to do it and make less, like do things that the expected return are lower than I could find elsewhere in the stock market or something like that. And I'm not willing to start doing that until I've sort of explained that to my partners and then given them the option to leave or
which maybe they don't want their capital spent that way. And if that wasn't kind of the original.
It's not the original deal, and so I would never do it. Now if I do I have no problem doing a private deal now or for a long time, but it's got to be one that I think is at least as good as my next best choice.
Right. And you still feel like public has a better chance of giving you that right now?
I think you still occasionally, I mean,
it's a tough question.
Small businesses are selling at pretty big multiples, right?
Yeah,
and especially, now to move the needle, I mean, my partnership's not that big, a couple $100 million, but, so it's got to be a reasonable size, and they're all trading at pretty healthy multiples for the most part.
Well, there's even micro PE funds that are out there, search funds, where they bring in an MBA and they try to plug them into it. I mean, it's moved down into places where maybe the market used to be more inefficient for those businesses, and I mean, money's just chasing everything, right?
Yeah, it's incredible how it's changed, and you would think 08, 09 would have shook some things out, but it I don't think it has. It was just kind of a pause and then right back to it.
Wasn't much bankruptcy, really.
I mean, one of the struggles is getting that ball started, right? Like, I would have thought I would have been able to find some since we had sold the other business, but so far, no go. Part of that's just I'm happy sitting in my office reading 10Ks and stuff. And not out there chasing them, but I don't know if that would lead to good results anyway if I did try to chase them. So
it's got to be one that you kind of trip over maybe, and it just seems like the stars align.
Somehow you get that. We'll see. I mean, I'm recently done a few things to try to get ready for it.
How do you skate to that puck?
I don't know exactly. I mean, the last couple of years, I've started down that route and then found that pricing and stuff was such that I basically backed off because I didn't want to start conversations with owners, and there'd be such a big gap between what I'd be willing to pay and what they want for their business that I would insult them in some way, and then that door's closed later.
Right.
I don't know if that's right or not, or I'm just using that as an excuse not to do the work. I don't know. I think there's a decent chance we'll get an opportunity in time.
So you think that's a little bit part of it, is that the things are kind of, we're long into a pretty long bull market, and the opportunity set maybe, especially even like 5 years from now, might be radically different.
Yeah.
And so if you were to push too hard right now, it's like, all right, what am I doing? What's the rush?
You can make it all up later. I mean, the old thing, I'd rather do it right than just do it to get it done,
Right.
To the extent I can. And try not to get married to the idea that I've got to do it.
Right.
Like if it doesn't, if the opportunities don't come along, then they don't come along. And that's not the end of the world.
Is there any business line that you're more interested in?
No, I try never to define it that way. I just try to, the old Buffett thing, define it. If I think I can figure it out, I don't want to take opportunities away because I'm not open to them, and I don't want, I don't want to get too married to one because I'm thinking this is what I've got to do.
Right.
One thing that the idea I like is, like I think what Craig and John, the guys that ran the gym, did so well, is if you can find a business where you have the opportunity to do something like they did, where basically every year, I mean, this is one of my biggest regrets in selling it, is basically we gave up 15 years or so of goodwill that we'd created with all their customers.
Yeah.
That in some ways they'd maybe not even recognized, but they feel it somehow, yes. Right? That, because what things in your life improve over time? Like, there's not too many things we use that over time get better. And if you find businesses that can do that, or that can do that and aren't doing that, and then start doing that, I think that would be rewarding financially, and also just a reasonable, a decent thing to be doing.
Right.
There's definitely stuff I would own in companies and in industries in securities market that I wouldn't want to own privately.
Really?
Yeah, I mean.
Like what, for instance?
Well, the first thing I did in 2000 was tobacco. Yeah. So I had about a third of the partnership in tobacco stocks, mainly UST. I have no moral qualms about being a super minority shareholder in something like that. I don't think, I have no problems with people argue you shouldn't either, but I don't know that I'd want to. There's a bunch of businesses I wouldn't want to own and operate and make the decisions about.
Right. Probably not going to be buying a strip club. You just don't have to go there, so.
Yeah, exactly. Especially with public securities and that, to try to say you won't invest in certain things and all that. I mean, it's a slippery slope because you're going to do right by every LP you have. They're all drawing their circles in different spots, right? That'd be pretty hard to manage. But it's just a personal choice, I think. I'm not trying to, make some moral statement or anything.
One that comes to mind right away, like Whole Foods. Okay, great company, seems to be doing, getting people to eat healthy, awesome. But at the same time, you could argue maybe from a biological perspective that McDonald's is doing more because you can get calories for so cheap there. And if you were truly a starving person, getting cheap calories is important to you. Whole Foods is expensive. Yeah. Those are expensive calories. And maybe balanced out on healthcare costs, in the full life of a person, maybe the McDonald's calories are actually more expensive than they seem. But who are you to judge which is better or worse? You start getting into some very slippery territory that seems obvious when you look at it from just a quick glance. Whole Foods must be more conscious than McDonald's.
I don't, those ones are really tough. It's like recycling, right? How much of recycling is actually useful? I don't know. I've seen lots of stuff which I tend to think is probably pretty close to the truth, that beyond aluminum, everything else shouldn't be recycled.
Oh, don't tell my wife that.
If you do the full equation on it, it's not that, it's actually not environmentally friendly.
The energy component of it.
Yeah, paper should probably be fuel for incinerators and stuff like that. I don't know, I have an answer on this, but could I imagine that the whole recycling stuff is more about trying to feel good than doing the right thing necessarily? And then then the whole industry gets developed. They get trucks, bins, all this stuff. Once it's there, to try to unwind that is pretty tough.
Yeah.
And I'm not saying that because I don't care about the environment. I'm saying because I think it's possible, it's better.
Yeah, if you took a first principles kind of engineering, true cost-benefit measurement of everything, that doesn't happen that often in the world, actually.
No.
We should just like to go right to the shortcut of well, that feels good, so let's just do that. And I'm going to ignore all these other conflicts that come along with it.
Yeah, so much of it probably, part of what's in your book, right, is that capitalism is kind of efficient that way, not necessarily because people are doing it by design. It's evolutionary, right? Like the winners, everyone looks at the winner after, says, oh, look, they really had figured it out and stuff. Well, maybe not. Maybe they were just trying something that happened to be the thing that worked,
you can't discount the spaghetti against the wall idea of capitalism. And even the idea that a lot of times entrepreneurs get it wrong to the benefit of the consumer. Like, they're subsidizing things a lot of times, and like everyone would think that capitalism like takes advantage of the little guy, but that doesn't necessarily have to be true at all.
Net, it's done wonders for the little guy. That doesn't mean it's perfect, but.
What do you think about maybe this is like dangerous territory to get into, but I just happened to see Ray Dalio recently talking on 60 Minutes about capitalism is kind of broken right now, and that there needs to be more redistribution from where we are today. Basically, like he said, billionaires should be taxed way more than they are, and otherwise we're going to end up in bloody revolt, basically.
I might have misinterpreted what he was saying. The headline that came across, I think it's dangerous to mess with. Certain countries and systems work so well. When you have something that's working, I think you've got to be very, very careful about messing with it. Little tweaks here and there maybe to try to improve it, but there's so many more ways to be dead than alive,
Yeah, that's a great point.
Once you find something that's alive,
just cling to that life raft.
Like don't, everyone's got their idea of how it can be more alive maybe or something. Now that's not to say, I guess history's probably definitely shown that if you get too much wealth disparity, it somehow reverts.
Yeah.
And maybe forcefully. But I would be really careful about changing the system too much. I mean, one thing that I would consider that you don't hear much talk about is payroll taxes.
Yeah.
That we talked about this yesterday, that if you think three options if you want to get something done, you outsource it to another country, get some kind of technology to do it, or hire someone to do it. Only one of them are payroll taxes involved with. And so, if you're worried about how labor does relative to other options, I would look at that.
It doesn't make a lot of sense.
No, we all argue about income taxes and stuff, but there's no discussion about payroll taxes. And it's a huge number.
In effect, it's sort of a minimum wage type of a thing where you move that up, and then you basically end up firing all the people their marginal product is below that.
Yeah, and I mean, a counter argument could be that money's funding, programs and stuff like that. But does it have to come from payroll taxes? I mean, to me, the goal is to gainfully employ your citizens and stuff, and then do those other things. But they don't have to. That money doesn't have to come from the same source.
Right. Don't put the friction point there in the system. I think that's a really good point about like the similarities between capitalism and nature and evolution. To me, and not just me, but like everybody, are very interesting and kind of seem obvious. But the idea that I'm a big believer that the onus is on you to prove when nature is wrong about something. Not that you figure it out, and then if it goes against nature, like you're probably right. Like chances are nature probably is right. And you have to, like, especially like, let's say like medical intervention. Broken arm, okay, probably makes sense to have a medical intervention. But some of the other problems that we treat, nature probably is the better choice, however that manifests itself. In capitalism, we kind of don't think that way. We think we know better. We think that we can like push on part of the system to get the outcome that we want, and it's a non-linear system and a complex adaptive system, and those kind of things, chaos theory, that kind of stuff. You push on you don't know where it's going to change it down the line.
And you're usually trying to deal with most recent problems that often by the time they start to deal with it are kind of self-correcting anyway.
Right.
You know, and then my main thing would be that thing. You got something that's working. That sounds like an old, excuse from people who are benefiting from the system.
Yeah,
hey,
I don't want change.
Don't rock the boat.
I like where I am right now.
So I can't say that isn't part of, I'd like to think that's not why I'm saying that, but maybe that's for others to make that call on. But yeah, it's almost like been my investment approach is find businesses that people think are going to die or be put out of business for one reason or another, and I think it's not as likely, because I think it's so, finding some business that's been around for 50 years and survived, and really their market share hasn't changed too much and stuff like that. That's pretty incredible that they've done that.
Yeah.
And I don't presume to think I know all the reasons why exactly it's happened, but occasionally I think there's a few you can kind of predict reasonably well, that
enough to where you get comfortable that there's persistence to that business, and at least not as bad as what the implied price is saying today.
It's interesting though, we talk about this. I've been trying to figure out how to think about these sort of new business models and get my head around them, and had come up with some general ideas of how you might think it's sort of simple models to think about them. And the short story of that is that it meant that if you're probably going to have this sort of winner take all outcome, that it wasn't, the variance in returns was going to be very wide.
Right.
If you did this stuff, and which was very different than what I had traditionally done, which is look for ones where I thought the variance wasn't very wide, that I wasn't going to have crazy returns, but I wasn't, the chances of bad returns were very low.
You can kind of safely ignore the tails a
yes,
little bit of the distribution.
That it wasn't a wide distribution, exactly. And here I thought I'd come up with this sort of criticism of a lot of people who are investing in these things and not recognizing this, and then talked about this and watched when Berkshire released all those old videos from the meetings. And I went to, from 96 on or to 07, I was at those ones, so I can't even say I wasn't listening to them.
You just had to hear it again.
Yeah, and they were talking about, they were pretty down on tobacco. People can go listen to it for themselves, but basically sort of political risk, and that it was just, I realized that they actually might have had the same sort of risk reward and payout structures that I was criticizing these new enterprises with. And here I had 30% of my partnership in tobacco stocks in 2000, and maybe I got lucky, that I shouldn't have been that committed to it. I don't know. Sometimes you can think things were one way, and it doesn't necessarily mean they were.
You valued one of the kind of unicorns using a kind of model of, I think you said like 90% chance of taking the entire market, and then 10% chance of it not working out, and basically
it was even lower than that. Well, I said if you just have something that's 95% chance of 20% return each year and a 5% chance of a 90% loss,
okay,
and you just play that out, you get this wide dispersion. The expected return's high. If you'd Kelly'd something like that, it would say put a very large percentage of your net worth into it. Yeah. At least assuming I did the math right.
But the tail risk.
But yeah, the tail risk, you have to basically never have that 5% chance of a 90% loss. And so what happens is the few that wouldn't get it have outstanding returns, and everyone else has subpar or really subpar. So it's kind of it's the winner take all result.
Yeah, it's power law playing out.
Yeah, and what moves the needle, I mean, it's hard, you can't, if you lower that confidence, if you think it's a 95% chance of happening, and it's actually really only, you don't have to drop it that much, like 85 or something like that, all of a sudden the numbers are really bad.
Yeah.
And
they get
and it's hard to be higher, more confident than 95, right?
Yeah.
About anything. But what really moves the needle is lowering that 90% loss. And anyway, at the time what I applied it to was Amazon, just based on the market price at the time. And I said, so how do you get that 90% loss? Do you think that means that the business has to be destroyed or something? It didn't.
It's already been down 80% at one point, right?
I mean, all it took, and I'm not even talking about stock price necessarily, I'm talking about business value. But if you just had Amazon normalized at 6% growth in perpetuity, this was, say a year and a half ago I did these numbers. So at any point, Amazon can grow 20% in perpetuity, but at any point it could go down to 6 and then permanently normalize there. Well, based on its market value at the time, in my view, it was going to go down 90%, down to fair value. And to have a business as big as Amazon already is, grow at 6% in perpetuity is huge. I mean,
long run return on capital in capitalism is around 6%. Right, so to assume anything north of that is very heroic assumption.
Yeah. So it's like I'm giving them the benefit of the doubt that there's this huge possibility they can continue to do, grow at crazy rates. And even in the worst case, they still are doing awesome.
They're doing average. And what do the numbers tell you at that point relative to the price?
Just saying that best case, you're making this bet that has a skewed distribution, that you have to kind of get lucky.
Yeah.
Now I'm not saying this fully explains a company like Amazon, but
so if you ran it with, let's say, 90% probability, what was your expected outcome, expected value?
I think if it was 95% chance of a 20% growth and a 5% of a 90% loss, and you run that, I think the expected return is something like 14.5 or something like that. You start dropping, I think you only have to drop the confidence level down to 87 or something, and now it's like 6%, or starts maybe even 0, or it doesn't take much.
Yeah.
In my view, being 95% confident, one thing about anything, but especially about stuff that is kind of it's almost like what's happened with monetary policy, right? We've never run this experiment before.
Yeah.
Anyone that thinks they know the answer, I think I
distrust right away.
Yeah. And in some ways, all these new business models is kind of the same thing to a degree, because we haven't seen, in some ways, if things are speeding up and each iteration's a little quicker.
Yeah.
That's the other one. Like if you look.
That's more at bats that you have to get right every time.
Yeah, and Walmart, you could say Walmart's sort of above average growth stopped at least 10 years ago when they were about 46 years old. Well, Amazon's already 23 years old, and if cycle rates are quicker, how old are they in that, dog years?
Yeah. They're 2/3 of the way.
Yeah.
What is today's price? And this is just a thought exercise, not an actual number, but how many AWS surprises are baked into today's price?
$800 billion market cap. You could argue, I don't think it's on, I don't want to in any way knock what Amazon's done. I use it all the time. It's incredible, right? Yeah. What they've done. It's just a valuation.
It's not personal.
I can't in any way get there. But there's some people who say they can. I don't know if they can or can't, and so far it's worked. But to me, the AWS thing is like a lot of the people who may have owned it over, say, the last 15 years or something, if AWS doesn't come along, where are you? And could you in any way have predicted AWS? I don't think so, when Google and Microsoft and all those guys missed it.
Yeah.
And if they missed it, that someone on the outside said, oh yeah, they're gonna do this, I think is a stretch.
It assumes such a innovation productivity from them for years to come that just historically has probably not been a very safe bet. How many companies have made a pivot from like a major business line and added another major business line? Not many.
Yeah, not many at all. More recently, yes, they're making more money, but yeah, back out AWS, back out the profits from Whole Foods. How much is the core Amazon really making? Especially in my view, if you do honest accounting with the share and option grants.
Yeah. Are they pretty substantial there?
Yeah, up until very recently, they might have been an equivalent value to, and this is just in the accounting of it, their book, to what their pre-tax profit is or something like that. So if you measure, and then I just did it, the number, I can't exactly remember how it came out, but it's just, I look at it two ways. How big is it as a percentage of their pre-tax profit? How material is it? And it's very material. And then how material is it just by dividing the number of employees by that number? And it's very material.
There's your wealth inequality.
And when the stock is going crazy.
Right. I mean, the expense goes up every day with the uptick of the
if I'm working there and my stock grants have gone up 50% each year for the last 5 years, I'm willing to work for a lot less cash. It's kind of a subsidy, right?
I would argue that it's actually even more expensive than that cost, because if you take some people who were hungry at one point when they started at Amazon and you give them options that turn into a $5 million portfolio, well, how much hungry are they? Like, how much have you taken off of the table of their desire to really want to kill it at that point? I think you hear about these companies that get acquired, like let's say Microsoft comes in and buys a startup, and everyone is vest and rest, right? They know they're cashing out, they have to put in 3 years in golden handcuffs, and then they're on to the next thing. That's a real cost on a business from an economic standpoint.
Well, it's what, I think you almost don't hear anything about it anymore. Now, it's nowhere near as egregious as it used to be.
Right, when they were just...
when I started in the business, with so many businesses, if you just did the option and the pension adjustments, income disappeared, across a lot of businesses. And
Buffett and Munger used to rail on that.
Yeah, it was just
relentlessly.
It was, if you just paid attention to that, you were way ahead of the curve. It was
so that was an edge.
Incredibly, that was an edge. Not necessarily knowing what to do, but it eliminated things from the that you wouldn't do. It gave you stuff not to do.
Shrunk your universe.
It's interesting. We've talked about it a bit. I think one of the things with the industry maybe struggles with, everything's about what to do, right? Which is present a good idea. And it probably is more important to think about what not to do. In some way that gets de-emphasized, I think.
Well, especially in a bull market long in the tooth, not everything, but almost everything's been working. And if that goes on for long enough, you kind of start to lose a little bit of that fear of what could go wrong. Probably not so much value investors, because we're a skittish bunch as it is, but general investors now it's more FOMO than it is fear of losing money.
Yeah.
It's probably a good place to wrap up, you think?
Okay, yeah. Thank you very much for having me on.
Not too painful?
No. Wait till I listen to it later.
Hope you enjoyed today's Hikecast. If you'd like to take me on your favorite hike, email me at 5goodquestions@gmail.com, all spelled out. Lastly, pick up your copy of the Rebel Allocator, available on Amazon in both print and digital formats, and soon to be Audible. See you on the trail soon.